the key message I want to get over really is the flexibility of the portfolio, and that yes, data center spend is very important to the shifting requirement and increase in required power demand as we look forward. But equally, there are pockets of capital that are going into the power system that are not necessarily dependent on data centers. And I give an example of the large regulated utility company in the UK, which will be growing its underlying regulated asset base at the fastest pace globally of any any developed market utility company in the next 5 to 10 years. And that does not depend on a data center. And that's important because it reflects the age of many of the grids that have not been fully invested in to keep pace with just even small changes in power demand use. And that capital profile is increasing at 6 to 7% per annum. So that provides what we view as quite sticky capital. And we can position the portfolio to take advantage of where the bottlenecks reside in each of those pillars of capital, whether it's in transformers, substations, high voltage cable, or critically skilled labour. And in fact, we think that's probably one of the biggest bottlenecks, certainly facing the US market, where power access to actual power capacity is a constraint, but equally so too is skilled labour. And there are a multitude of ways to play that too. And we like that ability to be flexible because, frankly, we're not tech investors, so we can't foreshadow precisely how those spending patterns might shift over the next 5 to 10 years from the large hyperscalers. But all we can do, alongside our tech colleagues, is to observe that, whilst the spend is in the trillions of dollars over the next 5 years, most of these companies have got very strong balance sheets and are still generating enormous amounts of free cash flow. So they can certainly wear that capital spend for quite some time. So we think there's a stickiness to that. Yes, the market's become quite erratic and volatile over recent weeks and months, particularly as it relates to AI data center companies, but we're really playing that CapEx vertical in specific areas. And then as we shift over to the more traditional side, I was highlighting how really the expectations around the end of traditional fossil fuels we've argued for some time are misplaced. We certainly don't envisage a return to GDP plus growth, but it's more that sense of the expectation of a peak and then subsequent decline, precipitous decline in demand. We just don't see it in the numbers that we look at. And the example I gave there was just to highlight the Repower EU policy that was advocating and trying to shift policy towards taking European gas demand down to around 225 billion cubic metres by the end of this decade annually, whereas the latest forecasts from industry experts are closer to 300, so a cool 50% higher. And that has serious implications for the required investment levels in traditional fossil fuels. And in fact, we envisage, as we reach out over the next couple of years, that lack of investment and what we see as a definitive peaking in US shale oil in particular, that will shift the pattern of cycles in the traditional energy market from short cycle, because the reaction function of shales is very quick, compared to the more traditional method of doing big mega projects to backfill future demand, which take 5, 6, 7 years to do. So we think there's going to be an extended cycle coming through traditional energy sources as well. And then, maybe the final thing just to sort of touch on is, things like the differences in different power markets to really illustrate that point we made at the outset, that the transition, if you want to call it that shift in capital investment into power and the materials required to make these transitions is very profound, but it will definitively push different countries at different speeds. And I think when you look at how China has tackled it, they've taken their consumption up by 8,700 terawatt hours over the last 20 years. They're now running at 10,000 terawatt hours, which is 2.5 times more than the United States of America. That 8,700 terawatt hours of growth that they've delivered in the last 20 years is pretty much fourfold, or rather more than 2 times Europe entire consumption that they've added over the last 20 years. So they really have got ahead of the game, we think, in terms of the available power to power their economy. Europe, unfortunately, is kind of caught somewhere in the middle because we don't have an abundance of affordable, accessible energy anymore. And that will have serious implications for the long-term industrial outlook for Europe too, again presenting some pockets of opportunity for the Trust to take advantage of. But I'll park it there and hand over to Tom.
Great. Thanks very much, Mark. And hopefully you can hear us clearly now. I'm sorry about that. So Mark's talked about how some of the changes that we're seeing in power demand and the shape of energy consumption and energy generation globally are creating constraints and bottlenecks in certain industries, which are creating some pretty exciting investment opportunities as companies are able to exploit these bottlenecks, have pricing power and growth, which we think endures beyond just a sort of 6 to 12 month flash in the pan, and where some of these companies involved in the supply chain for power, as well as the generation of power, are trading at a significantly lower multiple than some of the sort of higher profile beneficiaries or drivers of the AI revolution that take up, a far larger amount of the newspaper headlines, but, at the moment, a far smaller proportion of investor portfolios. And when we then think about constraints and mismatches between supply and demand, the energy transition and, the growth in energy demand from AI is something which is creating bottlenecks and supply and demand mismatches in materials as well. This is a materials-heavy transition. This is a materials-heavy revolution in terms of what is going on with AI. And when we look at some of the charts that you can see here, you can see just the scale of some of the increases in demand that are going to be associated with the energy transition over the next 10 and 20 years, both in commodities you'll already be very familiar with, such as aluminium and copper, and then also commodities which have a far more nascent market at the moment, where the vast majority of those markets are going to be made up of that energy transition demand. So on the far right-hand side there, a commodity such as lithium. And what we're seeing is that the ability of supply to respond to rapid increases or changes in the demand environment is really quite slow. And whilst governments around the world are enabling things like data centers to be deployed very quickly, whilst private capital is deploying at a rate which is almost unseen and unheard of before. Mark referenced the hyperscalers with significant volumes of capacity on their balance sheet, huge cash flow generation to support the investment into AI and into data centers. You don't see that same volume of capital being deployed into the minerals supply chain, and you don't see that same critical change in regulatory behavior to enable supply to be unleashed of materials, even if the capital was there chomping at the bit to be invested. And so we see some quite durable supply constraints across metals markets, in particular in base metals, as we look out into the early 2030s and beyond. And so we've got a series of investments across the portfolio from some of the largest producers of these commodities through to projects that we think are going to be able to deliver growth in supply to help meet this growth in demand that we see over the next 5 to 10 years. But the key is, I think, you want to be selective, in this approach. Not every company with, as what I sometimes call it, a treasure map and a dream in terms of a development project has the financing, has the management, crucially, has the regulatory and government support and the community support to enable that treasure map and a dream to become a project in cash flow. And so when you're looking down at that collection of smaller companies that we built, the tail of the mining exposure in the portfolio, we are quite selective in what we look for, and quality of management is one of the key criteria when assessing the prospects for these companies. We also want to be quite selective by commodity. Not every commodity is going to face constraints, and you can't just focus on demand here. If you look back during the China super cycle, aluminium, for example, was one of the metals that saw the most significant per annum demand growth during that super cycle. But the performance of aluminium as a metal was dismal in comparison to some metals, and that's because China was able to invest in new refining and smelting capacity in an almost unconstrained way. And if you look back at what worked in the super cycle, it was classically you went long what China was short of. So in this sort of power or energy cycle, which is a global phenomenon, not just a China phenomenon, you have to look at what should we be long of that different key components of that demand side are unable to unlock supply of. We think there it's a mixture of base metals as well as a couple of the critical minerals that you're seeing a lot of column inches dedicated to, in particular in the wake of some of the US policies to try and unlock supply in these globally critical areas. The slide here, just shows the chart on the right-hand side there, which I think is probably front and center of policymakers' minds when it comes to mining materials at the moment, and that's just the dominance of China, not just in mining of these commodities, but critically in the processing and refining of them. You can see there, the lion's share of processing of most metals sits in China, and I think this is going to be really what unlocks the permitting mindset in Western economies, which has really dogged projects in countries across the West that have been faced with permitting challenges. And it is finding those projects that are going to get unlocked fastest in the most sort of receptive environments that I think is going to prove important as we look over the next sort of 12 to 18 months. Equally, avoiding hype is important. There's been a lot written on rare earths, for example. Rare earths are not that rare. Processing capacity for rare earths, permits to produce rare earths, and permits to process rare earths are unfortunately pretty scarce. And there are going to be parts of the market that get overhyped. Now, you can make money in a hype cycle for sure, but we're investors, not traders. So you will see us avoid some of the areas of most significant hype in the portfolio. We do have some rare earths exposure, but critically there it's companies that have exposure across the full supply chain, therefore have something quite unique to offer the market. I want to touch on gold before we sort of look at the portfolio positioning and then open to questions, because gold is only a small part of the portfolio. When we made the transition to include the energy transition and power piece in our investment universe back in 2020 and changed the reference index for the fund, we removed gold from the mining piece of that because gold is not a metal associated with the energy transition. It is not what at the time was called a future-facing commodity. But the board was very clear that we would be still open to having tactical investments in gold. And I think gold today is a very strategic metal, but not for military reasons in the way that rare earths might be, for example, but from an asset allocation perspective. When you think about one of the biggest problems that is common across Western governments today and emerging markets, it is the problem of growing commitments, whether that is social, in forms of pension and healthcare, whether it's commitments to defense, or whether it's commitments to debt that has already been incurred, and how to solve for those with ever-growing expectations from the populations that keep these governments in power, no matter what form of government, democracy or otherwise, that is in place in these countries. And that problem of commitment affordability, debt affordability that stretches out beyond us is something that no one on either side of the political spectrum is actually proposing a solution for. Whether you're looking at the debates in the US, UK, or Europe, no one puts forward the idea that we're going to run a budget surplus anymore. How, therefore, can you solve for sovereign debt issues? And whilst gold is not the answer to those problems, it is part of the solution to building a financial portfolio that is going to be resilient to those problems and the unpredictable outcomes that those problems are going to create, the unpredictable policy responses that are going to occur. And I still think, we're in the early stages of this. I do think we're in the foothills of a monetary revolution over the next 5, 10, and 15 years, and gold is going to become an increasingly important part of portfolio resilience. If we look then at our sector positioning for the portfolio, and I think Mark highlighted in some of his opening comments about the flexibility of this portfolio. When we first made this transition 5 years ago to include energy transition, it was at a time when ESG investments were at the more fashionable end of market trends. And I think there were some shareholders that raised the question, are you just following a market trend here rather than thinking about investment returns? And we were very adamant that, no, this was about increasing, broadening and deepening our investment opportunity set to allow us to improve and hopefully increase risk-adjusted returns through time. And I think you can see that chart on the right-hand side there, which shows our over and underweight through time against the three main buckets that we can invest in terms of mining, conventional energy, energy transition. I hope that points to the fact we are pragmatic investment managers, very much looking at that returns focus rather than managers that are wedded to one particular part of the market for reasons that may extend beyond pure economics. When we made that inclusion of energy transition, many of the stocks that we were looking at, sure, had some exciting growth outlooks and growth prospects, very exciting products and services. But we saw the valuation of those relative to the other opportunities available to us in 2021, 22, and much of 23. Those valuations were unattractive. As we've gone through the last 12 months, seen a change in administration in the US, which caused a lot of negative sentiment towards this area in the market, but actually policies that reinforce the growth of some of these power-related companies and the emergence of very rapidly developing AI market, this area was left behind in terms of multiples, despite the fact growth actually looking better, arguably, than it did 24 or 36 months beforehand. So we've made quite a significant shift in the portfolios, now be overweight companies in that area and take down our conventional energy exposure. So I'll leave this slide here up and we can flick between the two during questions if you want to talk about that portfolio allocation. But I just want to leave we don't want to go into every individual investment in the portfolio, but hopefully it just leaves you very much with a clear understanding that we will invest wherever we see the most exciting investment returns across this quite broad investment universe. Can we now throw it open to questions, comments, challenges? And if anyone does have questions that they feel they don't want to ask on the line or would like some more materials and information to follow up on afterwards, please just reach out to Kepler and we will get answers back through them in a timely manner.
Brilliant. Thanks very much, guys. We did have one question. Obviously, we had the sound issue at the start. Were there any key points from first slide that you would want to stress?
I think just the overview slide.
Yeah, is there anything that, just a question, because we missed it, if you could just highlight anything you wanted to.
It was just a recap of the fund structure, the dividend target that's set out by the board each year, a recap of that change we made 5 years ago to broaden the definition of energy beyond just hydrocarbons, to try and re-inject that element of capital growth or structural growth back into portfolio, and just to comment about also how we use option writing to tactically try and generate a little bit of extra income to the portfolio as well. One thing I would stress is that whilst we are UK listed, obviously there's, we can't comment on the UK budget, but in a world where there is a lot of uncertainty, around the outlook in the UK, only a very small proportion of the investments held in this trust would have pound-linked exposure, and those that we do have, arguably actually, if you see yields fall, for example, in the UK would be beneficiaries of those. So quite different to some of the other UK investment vehicles, which would obviously have a lot more domestic exposure. This is a very international portfolio of assets here.
Thanks. We spoke a bit about the ESG energy transition fashion in 2020, 2021, and how you've been quite active in moving things around in that regard. Is there an anti-ESG pushback from institutional investors as well as the sort of political points that you discussed? And has that changed your views on appropriate multiples for these companies?
I think this can be a very tricky area to discuss. And I think it's also one with lots of misinformation and misnomers. When we look at what policy around elements of E, S, and G mean for us, it's about what regulatory support is there and societal support for investment trends that may benefit or indeed be headwinds to the companies that we look at. But also, what does it mean for investment flows into perhaps specific niches in the market? And when we look back at investment flows, say in 2020 through 2022, into areas such as clean energy, they were very, very substantial. And those pushed multiples up to beyond the level that we felt on a more medium-term outlook those multiples were higher than the growth rates that we felt comfortable with assuming for the underlying companies. Fast forward to today, and there are other areas of the market that are more fashionable, and yet the growth rates that some of these what you would describe as clean energy companies face is the same, if not higher, than some of the growth rates that would have been assumed 3 or 4 years ago. Now, of course, there are pockets where there were pre-revenue companies in that period that you referenced that have not been successful. They were concept stocks that have not been able to get their concept off the ground, and they will have suffered enormous share price falls. But when you look at companies that have real earnings and real cash flow, actually some of those in the energy transition space today are some of the most exciting opportunities, because they've seen capital outflows from those areas. You only have to look at flows, out of our sustainable energy strategies, for example, to see that, client capital has moved on and gone elsewhere. But actually, the opportunity set faced by those companies that are in that space are, I would argue, more exciting today than they were 24 months ago, given the outlook for power demand, for example. You take nuclear as well, which I know is sometimes a thorny topic. Look at the dramatic change in the regulatory environment and policy support for nuclear in the US. and that's opened up some exciting opportunities on the investment side there as well. That will also, though, see a flood of capital into certain companies there or subsectors, and see misallocation of capital, companies becoming overvalued, etc. And so we have to be cautious of that too.
I think just to reaffirm the well-made point that Tom makes is the way you should expect us to think about the portfolio is we're unlikely to be putting capital into concept stocks, as Tom mentioned. We like to think of ourselves, because of the bench strength we've got in the team across the different energy and mining pillars, that we're technology agnostic. So you're unlikely to see us take a large position in something that's focused on small modular reactors, particularly one where the stocks ripped up through the summertime on regulatory changes, executive orders from the US, and it's from its peak it's down about 50% because it has no real cash flows. It has not formally received the regulatory approval from the Nuclear Regulatory Commission, and it has yet to build its first SMR. So it may well be that in 5 to 10 years' time it becomes a winner, but it's not obvious to us yet that that's the case. The other thing we think very hard about as well is when we're assessing the value opportunity and growth opportunity in a technology such as wind, for example, we like to see, is there a technology that can stand on its own 2 feet without subsidy on any reasonable view? We can see that cost curve coming down and learnings are pushing down the cost and time to market. But frankly, there are pockets where we simply do not see that. And a really good case in point is offshore wind, where the challenges there, albeit it's a very small part of the overall global renewables market, has really struggled because these things are expensive and a lot of technological firsts going into them as well. And in one recent incident, we saw a company that had to downgrade its earnings on the back of a wind contract, which was a fixed price contract from the government, which was rolling off from 194 euros per megawatt hour. That's against forward prices of about 60 euros a megawatt hour in the market. So there's a very, very big gap between the prices required to still clear some of these technologies and the actual subsidy-free price that we still see. So we're quite conscious to try to separate those things out from concept stocks to things that we think genuinely can stand their own 2 feet.
Sticking with the same area, interesting question here. Where is the greatest opportunity, in the power providers or in manufacturers of solar panels and wind turbines?
So I think, again, there's, like everything else, there's little pockets of tightness in all the value chains right now. But if you step back and think really holistically about it, as that data center strength comes through, as the reindustrialization process occurs in the US, and as simple grid upgrades occur in Europe with data center demand somewhat further off in the future, but still real, the need for more power is definitely there. Now, power demand only needs to grow 2 to 3% a year to make it 3 times more than it's been for the last 20 years. And if you think about the analogy of, say, oil markets in the 2000s through to 2010, when China was really on fire, demand was running at 2% a year. It was still below GDP growth, and yet that turbocharged the underlying commodity cycle because we couldn't get enough stuff online fast enough. And it's very similar to the power market. So there's definitively opportunity in power, but the source of that power is important because we still think it's an all of the above. Because you're going to need contributions from solar, and there's plenty of opportunities there. You'll need contributions from onshore wind, and a little bit of offshore wind, but you'll equally need contributions from natural gas and contributions from nuclear. And again, there are tightnesses along each of those value chains. So if you pull it back to nuclear, which is quite an example, we think, it's assessing where the bottlenecks are. SMRs are super cool and interesting, and may well take off in 5 to 10 years' time, meaningfully so. But actually, the real bottleneck is in the mine commodity and the processing of the uranium ore as well, where we see opportunities. And regulation also shifting to turbocharge some of those opportunities, particularly in the US, where executive orders are now put on the critical minerals list. So if you can mine and refine in the US, you will definitively get a premium. for your product. And as we look out over the next 10, 20 years, China's still pumping in a reactor pretty much every year. As I mentioned at the outset, the UK is set to close many of its reactors towards the end of this year. Germany's closed reactors. Spain's trying to figure out it's going to close the last couple of reactors. But we think a lot of them are going to actually get extended because you just need it. And the perfect example of that is the blackout that occurred in Spain back in April, showing the fragility of the grid. We don't have that big baseload power available. So lots of opportunity on the power supply side, but equally just on the grid side, there's simply not been enough investment into the grid for decades. So even if there's no ultimate load growth coming through in the near term, the amount of copper wire, substations and transformers that have to go in are orders of magnitude higher than GDP growth, we think, at least in the next 3 to 5 years. And frankly, because capacity adds have been curtailed in a lot of those industrial processes for years, pricing power will definitively reside with many of these companies that are pretty exciting, we think. So those are the main sort of areas of growth. But then also, it's important to come back and remember there are more mispriced pieces of growth, we think, in traditional commodities as well. I'll give that example of gas demand being mispriced. Europe is probably going to need 50% more gas than the European Commission envisaged in about 5 years' time. China will need more gas than it anticipates right now. The US definitively will use more gas over the next 5 to 10 years. So lots of pockets of opportunity for mispriced growth, we think. So,
I think that's pretty comprehensive.
Yeah, thanks. We've got quite a few more questions. Have you try and cram them in? The AI revolution. Obviously, you've spoken a lot about the opportunities. We've seen a big, some concerns around NVIDIA and some of the application companies in that space. Are there risks, do you think, that if the AI revolution doesn't pan out as anticipated, is this going to have an impact down the line on your portfolio? Or do you think the genie's out of the bottle now?
Sure, I'll give a quick stab at that. So I think I can't speak to any individual names on the technology side, but I understand where that question is coming from in terms of obviously some of those companies have performed exceptionally well in the stock market, and what will performance be relative to expectations. What I would say is when you look at the deployment of capital that's coming, unlike in, say, the dot-com boom and subsequent fall, where there was a lack of earnings and certainly a lack of cash flow, the companies that are committing to this spend today are some of the best capitalized, highest cash flow companies in the market. Now, whether the value of that cash flow is too high in the market today or not is not what we are focused on. But make no doubt about it, I think this is an arms race between the West, particularly the US, and China. And it is one that is being, whilst it is private capital that is being deployed, it is clearly being enabled by, very open government regulation towards it, which is why you've got such a great investment environment. And you can see this in the investment numbers in China. You can see they've been over-investing in their grid relative to underlying, say, in manufacturing activity for the last 5+ years. And that is because whilst, for most of my life, whether it was my parents, teachers, or, subsequent colleagues saying knowledge is power, for the first time, since I can remember, power is now knowledge. And I think, this is a completely different environment in which we sit today. And I actually think, again, this is not a comment on AI-related stocks, but I think there is a risk that we are underestimating just how much compute power is going to be demanded and used over the next 5, 10, 15 years as a result of some of the applications that we're seeing today. I think there is effectively not an infinite use of it, but you think about just the number of applications that it could be used for, and I think it is going to be absolutely vast, and adoption rates today are very low. And the constraint is going to be physical. Whether that is materials availability, whether that is power availability, whether it's land availability and permitting, I think those are going to be the constraints. And as ever with these things, you want to invest where the constraints are, not where there are easy paths forward.
Maybe just to quickly add to that as well. When you think about the scale of the numbers, back to the end of 22, when ChatGPT really started to make the headlines, spending expectations for the big 7 tech stocks were in the order of sort of 220 billion a year. Those numbers since then have doubled. So we're spending $500 billion per year. Interestingly, they're still generating excess free cash flow beyond that. So the capacity for them to continue to spend is there. It's the willingness that I guess people are questioning. Now, as Tom said, it's very difficult to see what return on invested capital will be made from those dollars that are going in today. Very hard to tell when we're sitting here today, because much in the same way as we sat back in the early 2000s trying to figure out, how many clicks Google would get and therefore how much advertising revenue they make. It was probably orders of magnitude more than we could have imagined back then. And I think the same would be true too. There's always a risk of underestimating the cash generation that could come from that in 5 to 10 years' time. But critically, what the portfolio offers is more of a barbell, that those capital dollars are definitively still coming. But equally, there's so many opportunities where the capital spend is not attached to data centres. We feel very comfortable backing. Now, it may not sort of offer that rate of change growth that some of these concept stocks are talking about, but it's stuff that's bankable on a risk-adjusted basis where we think we can make money for clients. So that barbell approach is really important to us. Again, that flexibility with trust.
Thanks very much. We are running out of time, but so maybe we could make this the last question. Could you comment a bit on historical returns since the change of mandate, and what have been the sort of the key factors behind the good performance?
Fantastic stock, I think.
So I think there's been a couple of things. I think the first was, if you look back in that period, sort of 21 and 22, was that pivot that we made, really hard into conventional energy. We really were running a big underweight, during the deepest, darkest days of COVID. And when the vaccine was announced, it reduced that left tail risk quite a lot to oil prices in 21. And we closed that underweight quite quickly, and then went overweight, soon after. And I think having those stocks on the energy side that did very well in absolute and relative terms there, whilst you saw some of those energy transition stocks roll in relative and absolute terms, provided a really nice period of performance. And then subsequent to that, it's been a more kind of balanced portfolio where you've seen contributions from different parts of the portfolio at different times. I'd say actually the biggest surprise in the last 12 months has been how resilient conventional energy returns have been from an equity standpoint, despite the fact oil prices have been pretty lackluster. I think Mark spoke at the AGM earlier this year about how we weren't that excited for the outlook for oil, and Mark and his colleague Alistair on the conventional energy side have been pretty consistent on that through this year. But energy equities have actually performed quite well. So I think actually, when I look at the total return for the portfolio this year, it is better than we would have expected. Not necessarily on a relative basis, but on an absolute basis, because of the resilience of that conventional energy sector. As we look to next year, I think we're pretty excited about all three areas of the portfolio. in particular the energy transition piece in terms of some of those power companies and associated supply chains. Selectively in mining, where you actually have some very sort of interesting valuations at the diversified end, and probably more so on conventional energy, but that's maybe a late 26 into 27 story rather than something to hope that Father Christmas delivers in your stocking.
Brilliant. Great to end on an optimistic note. Looking forward to Christmas. Thanks very much, guys, for all that very useful information, and thank you for the questions in the audience. Hopefully you got everything you needed despite the sound problems at the beginning. We apologise for that. Do send through any questions if you'd like us to try to answer those afterwards. We hope we'll see you tomorrow, where we'll be hearing from the managers of Brunner and Baillie Gifford China Growth. Thanks, Tom and Mark, very much for your presentation, and have a good afternoon.
Thanks, everyone. Thank you.